what I often find with founders, they have so much passion for the problem that they solve, and they're so focused on solving the problem, the business is an afterthought.
Welcome to Scaling Without Breaking podcast, the show for startup leaders who are done winging it and sick of everything being a bottleneck. Your team's growing, the cracks are showing, and what got you here is officially breaking. Each week, you'll hear raw stories, sharp strategies, and real talk from founders, operators, and advisors who've scaled through chaos and built companies that run without constant firefighting. If you're ready to start leading like a CEO and move beyond just surviving, you're in the right place. Here is your host, Roland Siebelink.
Welcome, everyone. So glad to have you back on the show where we have amazing founders coming on week after week to talk about all the tricks that they apply to break out of their shell, to reach the potential of their startups, and of course, using a lot of AI to do so. So this week, our guest is extra special. I met him more than a year ago for a quick coffee that turned out, I think, a 2-hour discussion up in the new San Francisco Bayview area. And the guest spent years writing checks and sitting on boards at Francisco Partners, Riverside Partners, two of the most respected PE firms in tech. He saw dozens of companies from the investor's seat, and then he did something most investors only theorize about, maybe because their wives won't let them. He acquired a 25-year-old healthcare automation company and stepped into the CEO chair himself. Now he's navigating something really rare, running a company you also own at the fund level and proving that boring compliance workflow automation software is exactly the kind of thing that AI cannot replace overnight. With that, everyone, meet Ali Evans, the CEO of HCIM. Welcome to Scaling Without Breaking, Ali.
Thank you for having me, Roland.
Of course, Ali, it's been a long term coming, but I'm glad we finally made it. So I really want to delve into that difference in perspective between being a PE investor and being a CEO of a portfolio company of a startup, right? So let's start with that AI hook right away. Most PE investors I talk to, Ali, are terrified of AI replacing their portfolio companies. You went the opposite direction. You doubled down on a 25-year-old automation business. What are you seeing that all your colleagues are missing?
I don't know if they're missing anything. I think it really comes down to deciding what side of history do you want to be on. I think for us as technology investors and business builders, really, we are motivated by the opportunity to leverage technology for good and good of humans and good of people. And I think with HCIM, we saw a business that had really strong customer relationships, really deep expertise, and an earned reputation of trust. And, while the expertise certainly can be at least mimicked by AI and maybe even replaced by AI, we believe trust, we believe relationships are hard for artificial intelligence or other AI enabled tools like agents to replace. And so we think we can leverage that asset, leverage relationships, leverage the trust to then infuse our solutions with AI, infuse our solutions with more technology, and then bring that to our clients in a way that they can leverage and benefit from. And of course, that means we're going to be creative, we're going to be innovative with what we provide them. And it may change the business model, it may change the nature of our relationships, but we think that 25 years of hard-earned client relationship and trust is something that can be built upon.
Of course, of course. So tell us a story a little bit more about HCIM. How were they funded? What happened in that history? How did you land on them? And what made you decide to buy them?
Yeah, absolutely. So HCIM, the business was founded in July of 2000. It was founded by an ex-Blue Shield of California operating executive. He had built, multi-decade experience working inside of a large insurance company. And he thought to himself, hey, I could create a company to help more insurance companies like this one, like Blue Shield. I think quickly he saw, he was started off as a consultant. He was doing consulting for these organizations, and he saw the need for automation. He saw their teams were doing a lot of manual work, a lot of data entry, and he thought, wow, seems like software could do this. So fast forward, that person, he was nearing, retirement age. He wanted to transition out of the business, but, really cared a lot about the company continuing to flourish.
Mhm.
And, he wanted to find the right buyer. And so he went on a approximately almost 4-year journey to find the right buyer. And, to be honest, at first we didn't we did not come to agreement on terms on a
Mhm.
deal. We, really took some time to build a relationship, get to know each other. He considered a second buyer. That deal also fell apart. So eventually, I guess I was the third option, but we were able to kind of strike a win-win deal,
Mhm.
and ultimately, as part of that deal, I would become CEO. And I think he liked the idea that he got to know me, he knew my values, and we had some alignment there. And so he could have trust that he knew who the person who was gonna be leading his company that he'd, worked for 25 years to build.
But what I really wanted to delve into with you a little bit, Ali, was the difference in perspective between how a founder looks at the business and how an investor, a PE investor in particular, looks at the business. I think in our prep call, you said something like it sounds like they speak the same language, but the founder speaks Spanish while the investor speaks Portuguese. Can you expand on that?
Absolutely. I think one of the things for me, I was an operator before I became an investor, and so
Mhm.
I felt like my job is often to translate between the two languages. What I find is, business owners and founders they should be valued and applauded for what they do. They have an idea, they turn that idea into a solution to someone's problem, and then they can build an organization of humans who can then go solve that problem. Nowadays, maybe they just use AI agents, but somehow they solve that problem and they're remunerated for it in some way that creates a business. That's incredible. And I think
Mhm.
that very simple building blocks of understanding problems, understanding solutions, understanding business models that then, can make a sustainable dynamic of solution and problem. Those are common between founder and private equity investor. I think where the difference comes often is, well, how do we split the economic pie of how that the value that's created from that problem being solved? And so, what I often find with founders, they have so much passion for the problem that they solve, and they're so focused on solving that problem, the business is an afterthought. And so they'll say, okay, you know, I just want to get almost like the minimum amount of reimbursement I possibly can to afford my lifestyle, afford my team, allow us to keep growing the business so we can keep solving the problem for our clients in the market. I
Mhm.
think as an investor, it's a different calculus, which is okay, for every unit of risk I take, how much return can I generate? Oftentimes, what I see is that the founder thinks about, okay, well, I just want to solve more problems. The investor thinks about, I want to maximize that return per unit of risk. And the two sides can talk past each other. And so I think that in my experience, what I've tried to bring to the table with our companies is, you know, let me talk like the founder. Let me talk about solving problems for customers and really focus on that. But then let me, in the kind of in the background, let me think about, okay, well, how do I translate that into return and units of return? And so that's really where, both as a board member and now as a CEO, constantly trying to bounce back and forth between those two ways of thinking. It's important for founders to know the trade-off, right? Like there's something to be said for, there are founders. One that comes to mind is Judy Faulkner, the founder of Epic, the big
Epic, yeah.
electronic health record company. She owns 96% of Epic. Uh, she has complete control, and no investor will ever dictate what she wants to do as long as she's in control of the business.
And
And that's
alike,
by
yes.
design. Yeah, exactly. And that's by design, right? Like she wanted to be able to drive the company not based on generating a return for investors.
How does that play in your head, Ali, when you're in the CEO seat at HCIM? Is it easy to sometimes let go of the investor perspective, or do you constantly feel like, no, I have to look at it from both sides?
It's been a learning curve. I think one of the things that investors often underestimate is, even though we think like this, we think about units of risk per unit of return. Our employees do not. When I first became a CEO, I'd stand up and explain our strategy or explain the decisions we were making in the kind of context of risk and return or just how it would help our business grow. And what I realized is that that didn't really matter to our employees. And so what did matter is delighting our clients. And so
Hmm.
reframing what we were trying to achieve instead of talking about business growth, or revenue growth, or profitability, reframing it as, hey, we don't have any clients whose name is Sally. But if I said, we have this person, Sally, Sally's really happy with our product. This new strategy is so we can get more people like Sally to use our product. That would really resonate with our team. And so learning how to use different tools like that to reframe what we were trying to do was critical as a leader. And then I think the good news is having the investment mindset, it helps us make better decisions. I think a good example is, we are incorporating a lot of generative AI and large language models into our product, but rather than just building it for the sake of building it, like I think, some technology companies have done. A good example is, chat bots and knowledge base bots that, ingest your knowledge base and then they can be queried by your user base to ask questions. We didn't build that because our clients don't want that. And if our clients don't want it, they're not going to pay us for it. And so why would I build something that my clients don't want and they're not going to pay me for just because that's what everyone else is doing? I think as an investor, it's very natural for me to make that trade-off. Whereas instead, we are working on and building features that our clients do want and they will pay us for. And
I'm assuming your HCIM team is still pretty engineering heavy at this stage. How do you deal with engineers and product people that basically just want to build stuff that's cool?
it's a big challenge. I think you never want to stifle creativity and
Hmm.
innovation. And so I think what we try to do is encourage building things and testing things, but doing it from a how do we minimize the risk perspective and prove the return, proof of concepts. And so, okay, great. You have this great idea. Awesome. Like, thank you for bringing that idea. What's the proof of concept we can do that's low cost or low risk from a time perspective? And then what would need to be true for us to do the next test or the next iteration of this proof of concept. And I think when you incorporate people in the decision making process where they get to define both what is the test or what is the experiment we're going to run and what are the success criteria for that experiment and what is the next experiment that we're going to run after that, they feel and they truly have a level of autonomy and control over the process, which then creates ownership. And I think it's less about, oh, my CEO won't let me build what I want to build. It's like, no, the CEO is empowering me to build what I want to build. And they're just creating a process for me to build it that increases my probability of success. And so that's been the approach that we've used. It's not perfect, but it's certainly helping us make progress.
That kind of brings me to a question I often have about leadership, also with the portfolio companies we work with. People generally have understood that delegating and giving people some agency, as you say, is a good thing, right? Especially with the smart people we often hire. But setting a metric for what success looks like, or call it an OKR, or whatever methodology you want to use, is that the role of the employee or is that the role of the manager?
Different folks have different opinions. The debate of centralization versus decentralization is probably as one as long as business. Our perspective is we should decentralize as much as possible. But we try to centralize the what, but decentralize the how. And so what that means is when we say centralize the what, we care a lot about two things. How can we enduringly generate ARR or annual recurring revenue that grows free cash flow? That's the second thing we care about. That's the what. We will double ARR every 3 years, and it will generate an increasing amount of free cash flow over time.
Hmm.
That is what we're going to do.
Right.
How we do that is completely up to my team. For example, if, my engineering leader, for example, comes up with a metric and says, hey, every 2 week sprint, we need to ship 12 story points. I'm not going to opine on whether 12 is the right number or story points is the right metric. Like, I trust him if he thinks that that's the right metric that will lead to the behavior of generating free cash flow and doubling of ARR, I will trust him. Now, if we are not generating the free cash flow and we're not doubling ARR, then I'll ask him to revisit his assumptions. But that's the right way we try to coach and manage our teams, and that's both for me as a CEO, but then at the board level as well. When I'm working with my CEOs who report to me in other companies, work with your team to push the actual details as low as possible in the organization because they're the one closest to the problem. They're the one writing the code.
Mhm.
They're the one interacting with the clients. They have the best idea of what the details should be. We can just help them by setting the guardrails.
Private equity firms in general are also quite well known to then come in to the management team and kind of set that stage, right? Like, okay, from now on, we're going to all be working with metrics and we're going to be disciplined and we're going to have that context of higher cash flow, higher ARR. Um, that also means that in many cases, when they didn't have private equity investment, maybe some of these companies lost some discipline or never had it before. How do you deal with that as a new CEO coming in a team where maybe some of those habits have crept in and have been acceptable for too long?
It's a great question. I think it comes down to culture and what culture you define and what culture you set. When we first got involved with all of our companies, but HCIM included with me as CEO, you know, there wasn't that focus on metrics.
Hmm.
There wasn't as much of the part of the culture. And I think we tried to set a culture. First, we interviewed everyone in the company to get their thoughts on what the culture was and what are the things they liked about the culture, what are the things they didn't like the culture. So I think first of all, including the team as part of the process of building culture is critical. Like it can't just be
Hmm.
Ali's values; it has to be the company's values. But as you codify what you hear, you can then repeat back to people like, "Hey, I've heard across the team, we like this about a culture, we don't like that. I've observed when these things that we don't like happen, these bad things happen. Like when we don't have visibility into the metrics, we don't really know if we're doing well or not. So people aren't sure. Or when we don't have systems and processes in place, we get surprised and there's fire drills. And so you can kind of almost put up the mirror to folks around, hey, what are the aspects of our culture that we don't like and they're not generating the type of experience we want. And then from that, you can use that as fuel to then start the journey of adopting core values that reflect the culture we want.
I think it's relatively unique that a PE firm would lead with culture change. Is that something that your firm does it well in particular, or do you feel that this is more of a playbook many PE firms have learned to adopt over the years?
It's a good question. I think different firms have different philosophies. It also depends on the scale of the business. I think smaller businesses, it is often easier to mold the culture than it is in larger companies that may have more ingrained cultures. But I'd say, generally speaking, one, understanding the culture is a part of probably most PE playbooks, and then thinking through, okay, given the culture we're inheriting, can we embrace that because it's really good and it's generating the results we want, and we just want to
Mm.
kind of help it continue on its maturation, or do we need to make a change? And a little bit of it depends on your investment thesis. I think if you want the future to look the same as the past, usually you can embrace the existing culture. I think for us, when we invest in companies, we almost always want the future to look different than the past. That's kind of part of our investment philosophy is, we're buying good companies, but we want to make them extraordinary. And so how do we take something that was good and make it extraordinary where we're going to have to change some things?
So you still look at many companies, right? And in technology, software companies, I'm sure there's many that have been on the venture path before or tried to be. What is the difficulty in moving a team kind of off of the venture mill into the more private equity mill? And when do you decide to walk away?
So to your first question of moving from the venture approach to the private equity approach, the biggest challenge I see is that venture funded businesses often pursue growth and will throw people at the problem of pursuing growth, even at the expense of what I call unit economics, or else just the economics of a transaction. And sometimes especially in software, you can be misguided by gross margin. You can see, oh, my customer pays me $5. The hosting expense is, you know,
Nilch.
75 cents,
Right.
and, my customer support cost is, 25 cents. And so I'm getting $4 of gross profit. And so I'm profitable. Like I hear
Mm.
this from venture backed companies all the time. But I'll say, well, but what about the salesperson that sold it? And what
Mhm.
about the fact that you have maintenance, development that's to go for that existing product, just so that way you can fix bugs. And so then all of a sudden the contribution margin becomes negative very quick, and you're actually losing money. But organizations that are not thinking that way and the need to have to start thinking that way is a really challenging transition to have. We
Mhm.
have gone through that with some companies. We've helped companies go through that. I think the only way that works is if the leadership team, and it can't just be the CEO, it has to be the CEO plus, some other people who are going to be a part of the core nucleus. We're going to go through this really hard transition of changing our organization such that our unit economics work, such that, when we add a new customer, to support that customer, to continue development on the products that they buy, to, sell it and to pay our salespeople, it's still profitable. and
Mhm.
and
Mhm.
once they embrace that, then I think the organization is ready to potentially be owned by not just a private equity owner, but really any owner who cares about cash flow, and not just growth.
So, a new segment I'm adding into the podcast is these days is since you and I are both in San Francisco, Ali. People outside San Francisco often want to hear news from within the bubble, right? So, and I like how AI is driving so many breakthroughs these days. So I call this segment "Breakthroughs from the Bubble." What are you seeing? What are you seeing companies do differently because they are using AI? Maybe creative uses of AI, things that people haven't heard about. What is changing in the world because of this new manna that's been given to us?
And, I think there's a lot more marketing buzz than there is reality still, but I have seen some really interesting prototypes and proofs of concepts of companies building agentic workflows that go outside of just their one base application, what SaaS tool that they have, and kind of can interact with both other applications, within a organization's environment, and candidly the outside world, calling on, whether it be Uber carriers or or other type of human in the loop type uh, integrations of kind of AI agent plus human, which is really exciting. It kind of, I'll call it the last mile of AI value delivery.
Oh,
If
that's a great way of putting it. I love that.
if yeah, if you can mix kind of agent plus human until we have humanoid robots that can also execute, that is really exciting and something that we are watching closely.
So last questions are a little bit more about the person behind the business. Ali, let's get to know you a little bit more. What would you say when you were a kid or maybe a teenager? What were some of the things that could have predicted that you would become a successful CEO and PE investor one day? What were there people inspiring you, certain values, certain habits that you picked up?
Well, I first must say, I'm very much still on the journey. I humbly say, everybody is just a person trying to become the best version of themselves they can every
Mhm.
day, and I'm very much on that journey. I was very fortunate to have lots of role models in my life. My grandmother, she, taught me a lot about what I know about finances. I used to count uh, the offering at church with her in the evenings, wrapping coins back in the old day in a very manual, non-AI process with
Of
physical
course.
coins, if people can believe it. Foundations. My dad was a small business entrepreneur. He ran an IT managed service business.
Uh-huh.
Never really had more than 10 employees, but just an incredible leader and of people. And I learned a lot from him in terms of how do you treat people and interact well.
Was there some early manager perhaps that kind of saw the spark in you?
It's a great question. So, yes, and he's actually an investor now. So, when I was in college, I was curious about financial services and investing because I, you know, maybe done a little stock picking and heard that people do this for a living. So I emailed this person. His name's Jason, and I asked him if I could work for him for free as an internship, just to learn about investing because he was a professional investor. And, he worked at a company called Wellington, which is a very established, serious investment firm. And he was willing to take a chance on me. And so he invited me in. I was going to do a 4-week internship with him and really just shadow him essentially. And I remember coming in, with my very cheap, suit from, probably clearance at Macy's, and
Yes.
it's boxy and doesn't fit, and everyone there has very expensive suits, and they're kind of looking at me funny. But I I kind of just sat next to him in his office. I had my little laptop, and he would tell me to research stocks. And it really first sparked the interest of how do you mix analysis of an industry or analysis of just how some part of the world works, an analysis of a business that then operates within that industry, and an analysis of an investment and the price of which I should pay for owning a little piece of that business. And that combination of those three factors, kind of industry, business, and an investment analysis, I found fascinating. And I never would have learned how to do it had it not been for his kindness of inviting me for that 4-week internship several years ago.
That's amazing. That's amazing. And last question before we wrap up, but I think you made a link in our prep call between small town football and how you run a team today.
Yeah, absolutely. So, my firm is named Metamora. It's named after the camp we would go to for the first few days of football practice when I was a high school football player.
Oh,
And
that's
the reason
amazing.
being is it was the hardest experience I've ever had in my life to this day.
Uh-huh.
We'd go away to this camp, we'd wake up at 4:30 in the morning, and then we would have practices, 4 or 5 practices a day, finishing at 9 p.m. at night, completely exhausted for a week. And but what was interesting about that experience is it bonded us so closely as a team. You go through these
Mm-hmm.
crucible moments, it's incredibly challenging. You feel like you're not going to make it, but at that time there's 30 or 40 or 50 other people going through it with you, and so you support each other, you kind of bond together. So fast forward, we named the firm Metamora because when we invest in businesses, again, they're good companies, but they're not perfect. And so that means there
Yeah.
are going to be challenges.
Mm-hmm.
There are going to be new technologies that get introduced. There are going to be customers that go out of business. There's just going to be hard things that happen. And so for us, it's all about how we respond and do we bond together as a team and support each other. And so we wanted that to be a core part of our firm and how we built the firm. And so we named it that. And uh, like I said, we still have a long way to go, but we feel like we're on the right journey.
That's an amazing story. Well, thank you, Ali. I'm sure our listeners will love this whole episode. I love the specific stories that you added. If people want to be in touch, how can they reach you?
Yeah, absolutely. The best way to reach me is on LinkedIn. You can just search Ali Evans, and
Yeah.
I'm relatively active, so I will respond.
Excellent. Okay. And if somebody knows me and does not know Ali yet, I'm happy to provide an introduction as well, of course. Ali Evans, the CEO of HCIM and also the general partner, I think, of Metamora, right?
That's right.
Thank you so much for joining the Scaling Without Breaking podcast and sharing some of your breakthroughs from the bubble with us. For the audience, of course, we will have another amazing founder, CEO, venture partner here next week. So please keep tuning in.
The Scaling Without Breaking podcast requires more than a conversation. It takes action, research, and collective wisdom. If today's episode resonated with you, we'd love to hear your insights. Join the conversation and help us shape the future together. We'll be back with more stories, strategies, and real-world solutions that are making a difference for everyone. In the meantime, be sure to subscribe, rate, write a review, and share it with someone you think would benefit from it too. Thanks for listening, and we'll see you on the next episode.